Welcome back to the channel, everyone. Today, we are going to unpack a structural debt optimization strategy that is hiding in plain sight. It is a financial lever that 90% of American homeowners completely overlook, primarily because the entire mortgage apparatus, from big banks to local brokers, has conditioned us to default to a single, highly profitable and expensive pivot. Think about the sheer volume of noise in the financial media whenever the Federal Reserve adjusts the federal funds rate or when the 10-year Treasury yield moves. The immediate knee-jerk reaction shouted from every corner of Wall Street is always the same: it is time to refinance. But if you sit down and analyze how institutional lenders actually structure retail debt, you realize that refinancing is a high-friction, front-loaded cost game. It is a transaction designed to serve the lender's net interest margin just as much as, if not more than, your personal balance sheet. Today, we are pulling back the curtain on an entirely different, underutilized mechanism. This strategy allows you to drastically lower your monthly debt service, free up immediate cash flow, and de-risk your household liabilities without touching your current interest rate, without switching your lender. And for an administrative cost so low, it is almost laughable. Grab a notebook, open up your mental spreadsheet, and let's dissect the mortgage secret banks rarely talk about: mortgage recasting. 1. The anatomy of the refinance trap: friction, fees, and the amortization curve. To understand why recasting is such a powerful alternative, we first have to deconstruct the structural flaws of the standard refinance. As financially literate investors, you know the basic premise. You are essentially taking out an entirely new loan to pay off your old loan. When market rates drop, it sounds like an effortless win. But let's look closer at the friction points that quietly erode your financial alpha. The problem of sunk capital. First, let's look at the friction of sunk capital. A refinance is a transactional event. The bank requires a full suite of services to close the new note: origination fees, processing fees, underwriting fees, title insurance, and independent appraisals. On average, these closing costs consume between 2 and 4% of your total loan balance. If you are refinancing a substantial mortgage, you are instantly writing a check for $10,000, $20,000, or $30,000. You are essentially taking a massive bite out of your liquid net worth just to secure the right to a lower payment, meaning you start the life of that new loan in a significant equity hole. The amortization reset. The second, more insidious issue is the amortization reset. This is the silent wealth killer of the American middle class. Standard American mortgages are structured on a 30-year fixed schedule, utilizing a heavily front-loaded interest curve. In the first 7 to 10 years of a mortgage, your monthly payments are overwhelmingly tilted toward interest, with only a tiny fraction chipping away at the actual principal. Imagine you have faithfully paid your mortgage for 7 years. You have endured the worst of that interest-heavy phase, and your monthly payments are finally starting to make a meaningful dent in the principal balance. If you refinance into a brand new 30-year note to chase a slightly lower rate, you reset that clock completely back to zero. You are signing up to pay front-loaded interest all over again to a new lender. When you calculate the true net present value of those monthly savings against the reset timeline, the math often reveals that you haven't actually saved money at all. You have simply kicked the debt bucket further down the road. Refinancing only makes mathematical sense when the yield spread between your old rate and the new rate is wide enough to overcome both the upfront closing fees and the structural damage of resetting your amortization curve. If that spread isn't wide enough, you are just paying thousands of dollars to restructure debt that didn't need to be touched. 2. The elegant alternative: how mortgage recasting actually works. Now, let's look at the alternative. What if your goal is to optimize your monthly cash flow reduce your total debt obligation, and maintain your current equity position without paying thousands of dollars in junk fees or disturbing your timeline. This is the exact operational window for mortgage recasting, which some institutions refer to as loan re-amortization. With a mortgage recast, your original loan contract remains fully intact. There is no new underwriting, no new title search, and no new appraisal. You keep your current loan servicer, you keep your original note rate, and most importantly, you keep your existing maturity date. The clock does not reset. The mechanics of a recast. The operational mechanics are remarkably elegant. You experience a liquidity event, perhaps an annual corporate bonus, stock options vesting, an inheritance, or the cash proceeds from selling a previous property, and you deploy a significant lump sum of capital directly toward your current principal balance. Now, if you were to simply send a big check to your bank without specifying a recast, the bank would apply that money to your principal. Your total debt would drop, and you would cut years off the end of your loan term, but your mandatory monthly bill next month would remain exactly the same. For an investor looking for immediate cash flow optimization, that does not solve the problem. When you execute a formal recast, you are instructing the bank to do something entirely different. You tell them to take your newly reduced principal balance and recalculate your remaining payments. They stretch that smaller debt amount across the exact number of months left on your original timeline. Because the debt pool is much smaller, but the time allowed to pay it back remains the same, your mandatory monthly payment drops dramatically. 3. A direct case study comparing the capital efficiency. Let's step away from theory and run a concrete, side-by-side mathematical comparison. Let's assume a very realistic scenario for an urban professional or a high-earning household. You have an existing mortgage with a principal balance of $800,000. You lock this loan in during a higher rate environment at a 7% fixed rate on a 30-year term. Your baseline principal and interest payment is sitting at approximately $5,322 every single month. Let's look at how the two different strategies handle this situation. Strategy A, the traditional refinance. Let's say market conditions soften slightly. Rates drop by a full percentage point down to 6%. You decide to execute a standard refinance on your $800,000 balance. Your new note rate, 6%. Your new timeline, 30 years, resetting the clock to 0. Your new monthly P&I payment, roughly $4,796. The result, you have optimized your monthly cash flow by $526 a month. That feels like a win until you look at the transaction statement. To secure that $500 monthly reduction, you had to pay an average of 3% in closing costs, which amounts to $24,000 out of pocket. If you divide that $24,000 fee by your monthly savings of $526, your break-even horizon is more than 45 months. That means you have to live in that house and keep that exact loan for nearly 4 full years just to win back the money you spent to do the refinance in the first place. If your life changes, if you relocate for work, or if you upscale your home before those 4 years are up, you have actually lost net worth on the deal. Strategy B, the strategic recast. Now let's look at the exact same baseline scenario, but this time you leverage a recast. Let's say you receive a $200,000 lump sum of capital from a liquidity event. Instead of refinancing, you keep your 7% mortgage and execute a formal recast by deploying that $200,000 straight into the principal. Your new principal balance, $600,000. Your note rate, maintained at 7%. Your timeline, maintained at the remaining months of your original loan. Your new monthly P&I payment drops to approximately $3,991. The result, you have optimized your monthly cash flow by a massive $1,331 every single month. Now look at the transaction friction. The administrative fee for a bank to process a mortgage recast typically ranges between $150 and $500. Let's look at the sheer capital efficiency of this move. You didn't waste $24,000 on bankers, lawyers, and appraisers. Every single dollar of your $200,000 went directly into building your own equity. Your break-even horizon is practically instantaneous because the fees were negligible and your monthly cash flow expanded by over $1,300. 4. Institutional incentives. Why lenders stay quiet. At this point, any analytical thinker has to ask the obvious question. If recasting is this clean, this cheap, and this effective, why isn't my bank actively marketing it to me? Why isn't my loan officer calling me every quarter to pitch a recast? The answer becomes obvious when you follow the institutional incentives. Banks are profit-maximizing corporations, and retail mortgages are highly engineered financial products. When a bank convinces you to refinance, it triggers a massive windfall for their corporate balance sheet. They harvest thousands of dollars in upfront origination and processing fees today. Furthermore, by resetting your loan term back to 30 years, they guarantee a longer, highly profitable stream of interest payments over the next 3 decades. Often, they will package your brand new loan into a mortgage-backed security, sell it off to institutional investors, and pocket an immediate gain-on-sale profit. When you execute a recast, the financial reality for the bank is terrible. They don't get to charge you thousands of dollars in transaction fees. They collect a nominal $250 administrative fee that barely covers their internal labor. More importantly, by allowing you to instantly slash your principal balance by $200,000 while keeping the same maturity date, you have severely reduced the total amount of interest they will ever collect from you. You have essentially deflated the yield of their interest-earning asset. They have no economic incentive to educate you about this option. 5. The capital allocation framework, assessing opportunity cost. As sophisticated investors, we must never analyze a financial strategy in a vacuum. A recast is a powerful tool, but it requires a massive deployment of liquid capital into an illiquid asset, your home equity. Once you pump $200,000 into your mortgage principal, that cash is locked up. You cannot easily use it to pay for emergency expenses or seize a sudden market opportunity without taking out a home equity line of credit, which brings its own set of costs and interest rates. Therefore, we must evaluate the opportunity cost using a strict capital allocation framework. The arbitrage environment. If you bought or refinanced a home during the historic macro lows of 2020 or 2021 and you are sitting on a mortgage rate of 3%, executing a recast is generally a poor deployment of capital. Sinking $200,000 into a property to avoid a 3% interest charge makes very little sense when the risk-free rate on short-term treasuries or high-yield cash instruments is yielding 4 or 5%. In that environment, you can capture a positive arbitrage spread simply by leaving your money in a liquid, risk-free asset rather than locking it up in a low-rate mortgage. The high-rate environment. However, look at how the math flips if you secured your mortgage in a higher-rate environment where your note rate is 7% or greater. When you deploy capital to wipe out a 7% debt obligation via a recast, you're not just saving money on interest. You are locking in a guaranteed, risk-free, tax-equivalent return of 7% on that capital. Think about that clearly. If you try to generate a consistent, risk-free 7% return in the public equities or bond markets, you will find it is almost impossible without taking on equity market beta or duration risk. Furthermore, investment gains in the market are subject to capital gains taxes. A mortgage recast gives you a completely risk-free, tax-free return equal to your note rate because you are preventing that interest from ever accruing. In a volatile or overvalued macroeconomic market, a guaranteed 7% return is an incredibly strong defensive play for your portfolio. The defensive cash flow play. Beyond the pure mathematical yield, there is a behavioral and operational component to consider. Recasting is a phenomenal defensive strategy for personal cash flow stability. If you are planning an imminent career pivot, preparing for retirement, transitioning to a single-income household, or simply looking to structurally de-risk your life by lowering your fixed monthly overhead, reducing your mandatory debt service by hundreds or thousands of dollars a month creates an incredible financial cushion. It provides peace of mind that a volatile brokerage account simply cannot match. 6. Operational execution. How to pilot the system. If you have analyzed your position, weighed your opportunity costs, and decided that a recast aligns perfectly with your wealth management goals, you need to understand the operational rules of engagement. If you do not execute this protocol precisely, the bank will default to handling your money in a way that benefits them, not you. Step 1. Verify loan typology. First, you must check the regulatory structure of your debt. Conventional conforming mortgages that are held or backed by Fannie Mae and Freddie Mac almost universally include a recasting provision in their servicing guidelines. However, if your mortgage is a government-backed instrument, specifically an FHA loan or a VA loan, traditional recasting is structurally unavailable under standard program guidelines. If you have a government-backed note, you are locked out of this specific mechanism and would have to look at other refinancing options. Step 2. Establish the capital threshold. Servicers will not re-amortize a loan for small incremental payments. They do not want to run calculations because you sent an extra $500. Most major institutional servicers mandate a strict minimum principal reduction threshold to trigger a recast. This baseline typically starts at $10,000 or a specific percentage of the outstanding loan balance. You must ensure your liquid capital event meets or exceeds this operational floor. Step 3. Avoid the operational trap. This is the most critical step in the entire process. Do not simply wire a lump sum of money into your standard mortgage payment account and assume the bank will automatically recast your loan. If you do that, the bank's automated accounting systems will simply classify the transaction as a standard principal prepayment. They will apply the cash to your balance, your total lifetime interest obligation will drop, and your loan will mature faster, but your mandatory monthly bill next month will remain exactly the same. You will have completely failed to optimize your current cash flow. Step 4. The proper script. To execute this correctly, you must bypass the standard automated payment portals. You need to call your loan servicer directly and ask to speak with their loss mitigation, special loaning, or loan modification department. Use the exact technical terminology. Tell the representative, I am preparing to make a significant principal reduction and I want to request a formal mortgage recast and re-amortization of my remaining balance. The servicer will initiate an internal administrative workflow. They will mail or email you a formal legal document called a recast agreement or a loan modification rider. You will execute this document, return it to the bank along with their nominal processing fee, and wire the lump sum capital directly to the designated recast clearing account. Within 1 to 2 billing cycles, the bank will update their ledger, issue a new amortization schedule, and adjust your mandatory monthly corporate billing statement downward. The bottom line: true financial engineering isn't a privilege reserved solely for corporate balance sheets or institutional hedge funds. It is a discipline you should apply to your personal wealth portfolio. Refinancing is an aggressive, high-cost strategy that rewrites the underlying debt contract, often resetting your progress and feeding the banking ecosystem in the process. Recasting is a highly efficient alternative that keeps your contract intact but changes the mathematical calculation of your cash flow. One method extracts fees to support the bank's bottom line. The other directly optimizes your personal capital efficiency. Take a look at your current note rate, analyze your liquid cash reserves, calculate your opportunity costs against alternative asset classes, and run the math for yourself. Never compromise your core emergency liquidity pool just to execute a principal reduction. But if the capital is available and the interest rate environment is right, it is time to stop letting the mortgage industry dictate how you manage your liabilities. Thank you for tuning in. Drop your mathematical calculations, your experiences with your loan servicers, or your thoughts on capital allocation in the comments below. Let's keep building wealth intentionally. I will see you all in the next analysis.